All right, thank you very much for the opportunity to discuss this nice paper. Let me start from the beginning. What is LASH? What is LASH risk? All right, so hedging is often done via a derivative product that entails two things. Receiving a payoff in the bad states of the world. In this case, is the low interest rate environment. And making a payoff in the good states of the world, high interest rates. Now, what happens is that derivative products are often associated with an embedded counterparty risk insurance, like a margin call, if you will. And that entails two additional payoffs. Receiving an extra payoff in the bad states of the world, simply because this insurance product reduces counterparty risk. And also making an extra payoff in the good states via the provision of cash collateral. So what is LASH risk? LASH risk measures how much of this cash collateral you need to provide if we switch today to a better state of the world. That's what LASH risk is. Very quickly, two things that LASH risk is not. It's not the higher moment of a given distribution of return. It's not like equity risk. It's more it's a sort of elasticity. It's a bit like your value at risk or DV01. It's also not exactly the cost of obtaining this liquidity. It's really the amount of liquidity. Let's see. All right. So what happened during the mini budget crisis? So the mini budget crisis led to an increase in UK interest rate. So in principle, it's a better state of the world. This triggered margin calls. And unfortunately, some or most of these funds could not access the repo market. So in order to meet the margin call, they had to sell liquid assets. And the price was actually unfavorable at that time because the interest rates were high. Okay, so why should we care about LASH? As stated in the paper, it's large and it affects an important sector, pension funds. And it's also complicated to hedge. One may think that, you just keep a pool of liquid assets to hedge that. The problem is that this pool of assets loses value precisely in the good states of the world, when interest rates are high. Also, granted, your solvency improves in the good state of the world, but you cannot really borrow against that because this improvement in solvency is hard to verify. So the authors came up with something big that we should care about. So where could the authors go from here? I found two ways, and I'm going to illustrate the second. One way is to come up with a systematic study of LASH across all types of derivative products. So for the moment in the paper, they deal with repo and interest rate swaps. It's nice, but it would be even nicer to get a full picture of this risk. Second way is to further articulate the trade-offs between solvency risk and LASH risk. And this is what this discussion is going to be about. And it could be entitled, Why LASH Risk is Slightly Less Bad Than One May Think. Okay. Let me start with explaining something about correlation that I'm going to exploit later. Take your typical liquidity risk. And by typical liquidity risk, I'm talking about run type of. By definition, this type of risk is positively correlated with solvency risk. The solvency risk triggers illiquidity, liquidity risk, and then it reinforces each other. It's positively correlated. Now, LASH risk is different, mechanically different. It has a negative correlation with solvency risk because it arises in the good states of the world. That's something that the paper has, right? They really have this positive correlation and negative correlation. What the authors did not do is the extra mile. Is that there is a simple corollary to be made. It means that LASH risk is actually negatively correlated with your typical liquidity risk. And I'm going to argue that this has two important benefits. Imagine we live in a world where funds try to hedge liquidity risk by keeping a pool of liquid assets. What I'm going to argue is that thanks to the negative correlation, a given fund can use the same pool of liquid assets to hedge both types of liquidity risk. And why? Because your typical liquidity crisis and LASH crisis are unlikely to arise at the same time. If LASH risk was not there, you would hold a pool of assets that is useful only in one state of the world. Now it's useful in two. What does it mean? Two benefits. The first one is that LASH risk is cheaper to hedge than thought. The presence of LASH risk, because of the negative correlation, requires little to no additional liquid holdings. That's one thing. Second, well, maybe LASH risk is slightly less destabilizing than thought. Now the net present value of hedging is higher. A unit of liquid assets can hedge now not one, but 2 units of risk. Which means that because there is LASH risk, precisely, a rational fund should be incentivized to hedge more, all types of liquidity risk, both LASH and your typical run type of liquidity risk. And again, this is due to your higher NPV of hedging. This was just to illustrate one way that the authors can systematically think about whether LASH risk is bad, what is the role of LASH risk in the stability of the financial system. Let me conclude. LASH risk arises from an embedded counterparty risk insurance. If you want to be very nerdy, you would say that it's a state-dependent payoff of a counterparty risk insurance embedded into a solvency risk insurance product or margin call risk. It's large. It's hard to hedge, and it affects an important sector of the economy, pension funds. Now, I encourage the authors to do either, or actually, ideally both, complete the pictures by systematically quantifying LASH across all derivative types, and they have the data for it with the UK EMIR data. I know it's dirty, but somebody has to do the job. Or, ideally, study more in depth the trade-offs between solvency and LASH risk. Now, I gave one way to go about it. Because LASH is negatively correlated with other types of liquidity risk, it may be slightly cheaper to hedge and maybe less destabilizing than thought. But it's an important topic, and I enjoyed reading the paper. Thank you.
Thank you for the great discussions. I think we have time to collect a couple of questions from the floor, and then I pass the floor to you. So who wants to ask a question? Yeah, Philip.
The shortest question of the day. So why is that not just another wrong way risk?
Thank you very much. It's a really interesting paper. I mean, I had a similar thought in terms, I had the same thing, and it made me back to the question about to what extent is the result dependent on the fact that everything here is sitting in the gilt market or sovereign bond market, and so pension funds are that you didn't go through that, whether there were more alternative assets or different assets in the side would reduce the solvency risk. You'd have more diversity either across jurisdictions or between having something that didn't move in such a correlated way. Also because it will be the gilts that are behind the repo market if the repo market were to be functioning, because that was the other issue that you didn't, I felt I didn't get a full explanation of why did the repo market not function for those institutions. Thank you.
Thank you. Any other, maybe last one? The professor also says, small suggestion. I find the word, I mean, this is a very silly question, but, I find the word LASH risk not very memorable. Perhaps you can find another name, because, I mean, I know that these are the initials, but, I mean, I'm sure that in 6 months, I will not remember what LASH risk, I mean, it needs to have a more evocative name, I think, so, to be remembered. In that sense, maybe, yeah, okay. Yeah. No, but I don't mean that. I mean, I may remember LASH, but I may not remember what exactly LASH is. Perhaps think about giving a more kind of a name more connected to the issue you are dealing with. Okay, so I think you have a good kind of 5 minutes to address. So.
Thank you very much, Solisha. Just to pick up on your last point on the memorable name, we were debating at some point whether we should change it, but then actually a former prime minister picked it up. And then, there is this big FT article called, LASH risk. So now we are set on the name. So unfortunately, we did think about it. So thank you for that. Now, thank you, Jean-David. Fantastic discussion and very conceptual discussion. So I really appreciate that. Now, you're bringing up a very important point on the interaction between typical crisis and LASH risk, which indeed kind of go in opposite directions. So then why not hold liquid assets that would cover both? And I think this point actually very much speaks to what we're trying to bring home, that this risk is not specific for pension funds. This can apply to a lot of other instruments. This can apply to a lot of other kinds of institutions, as long as you have some sort of duration mismatch and you're trying to have, well, in this case, duration mismatch, but if you're trying to hedge something, right? And indeed, for a normal, so maybe for pension funds, a typical crisis would affect it differently, right? So you mentioned bank runs, whatnot, right? So perhaps for pension funds, you can't, maybe it's more difficult to have these both at the same time, like being exposed both to a typical crisis and to this LASH risk. However, indeed, this really brings home the point that for an institution can be subject to two at the same time. So for example, a bank trying to hedge their FX risk. Now so it really goes along in pension funds. Now, looking at all derivative types, I think you're giving us more work. Indeed, so in an ideal scenario, what you would like to do is you'd like to combine this with all your hedging requirements, not just the interest rate requirements. I think that will be maybe another paper. And again, with FX, then you can look more beyond non-bank finance, non-NBFIs. Here, we just focused on that. But you're right to say that, if you will, this LASH risk is actually understated as well, because we just look at risk arising from one product. Now on the wrong way risk. So maybe I should have said early on, great question, thank you. I should have said early on, we're not reinventing the wheel in the sense of, this crisis happened before, so that's why when you first said the commodity one, we keep on getting this example from Germany, a name I can't really pronounce, a crisis of Metallschaft something. That one, which was in the 60s? No, 90s? No. So this again speaks to, again, we're not reinventing the wheel. This is something that happened before. However, what we're trying to do is to think about the framework and to think about the concept. Why is it not just wrong way risk? Sure, specifically for an instrument, indeed, you can think of it as the wrong way risk. However, again, thinking in a more broader point, we're trying to think about what you're trying to hedge, what's going to be the risk that comes out of that. I think in a very finance term, you can think of it more in terms of the wrong way risk, if you will. Now, specific to gilts, thank you. So we've been getting this question as well. So I don't think it's specific to gilts. I think what makes it specific to gilts, if you will, for these UK pension funds is indeed perhaps they're more exposed to government bonds than, let's say, the US pension funds are. However, there is this great paper by colleagues at the Fed with Nathan, well, in any case. Sorry, yes, yeah. And where they show that these pension funds, that the US pension funds actually are exposed and they repo other kinds of securities, right, which are not gilts. So this can apply on the same structure there. So okay, sure. In this case, the crisis, for example, really linked, if you will, to this change in interest rates. However, this can happen in the US for their exposures to non-government bonds. So we think this is again much broader than that. And yeah, why did the repo market non-function? Again, maybe indeed in this specific backlash example. So Jean-David, we used to call it backlash. So going back to bringing point, whiplash. So we had a lot of variations on that as well, but then we thought we were pushing it too much. So in this specific case, fine, but this can apply to anything, and you can repo much more than just government bonds. Thank you.